Welcome back, YouTube family, and in today's episode, I'm gonna make you rich by the time you retire. Now, a lot of people are like, I wanna be rich now. Well, maybe you should hit the gambling tables because that is not what today's video is about. Today's video is all about what the financial institutions at Wall Street don't want you to know. And this entails everything from 401ks to IRAs to fees to mutual funds to ETFs and pretty much everything that you should know about your financial future. So come on this ride with me to your financial freedom and let's jump right in. Let's go. All right, so for context, you gotta know that the average returns for the S&P 500 index is around 9 to 10%, 9.8% to be exact. And the next thing to know is that a lot of financial advisors will tell you, hey, you should have a 401k or an IRA, and that is true. But there is a specific way to have it that is more advantageous than just getting one with your job and letting it sit there and just build on its own. And by the end of this video, you'll know exactly what I'm talking about and how you can get the absolute most out of your retirement account. So next, we're gonna look at the fees behind 401ks. And as you can see here on the screen, the average all-in fee is around 2.22% for all 401k holders. That's obviously the average. You can have ones that cost less, you can have ones that cost more as well. And we'll talk about the ones that cost the least. But why is this important? Well, fees play a huge role in where our money will be in the future. And you might be thinking, what does 1, 2, or even maybe 3% really entail for my money, right? How is that really going to impact my future net worth? It sounds like only, a little bit of money. Well, to truly understand that, we'll have to look at this graph here. This is a simple chart showing how compounding growth of $5,000 invested annually and how that will exactly impact our money down the road. As you can see here, the starting point on year 0 is a nice cool $5,000. But once you get into year 10, the 9% is $10,000 more than the 7%. And 20 years in, this has escalated already $60,000 ahead of the 7%. The 9% at the 30-year mark exceeds the 7% by a whopping $250,000. And if you started investing early enough, the 40-year mark shows us that we're almost $1 million ahead with a simple growth rate of 9% versus 7. Obviously, we can look at the 50, 60, 70, and 80 years, but most of us are not going to be invested for that long unless we have some sort of trust set up. And whether or not you invest $5,000 or $1,000 or $10,000 a year into your 401k or IRA, you should definitely take fees into an account. And that is where a self-directed IRA comes into play. Some companies will let you have a self-directed IRA, but you need to talk to your employer first. And if they don't, they might let you move your IRA or 401k into a different account. But the only way to know that is by actually talking to your employer. Now, some of the companies that have 0% fees are companies like SoFi or E-Trade. Also, Fidelity has a really nice Fidelity Roth IRA right here, which also has no account or advisory fees and allow you to invest into different things. Now, that's just a simple Roth IRA, but a self-directed IRA is a little bit different. And so here are some of the pros and the cons that come with a self-directed IRA. So with a SDIRA, you can invest the funds in assets such as real estate, non-traded businesses, and other speculative assets. Although you will need a trustee or custodian that specializes in less typical investments, and there is a possibility for you to get high returns. Of course, you will have more portfolio diversification, but there can be higher risks with the riskier assets. And so if you were thinking, well, I would just want to coast, I just want to be able to control my money and put it in the markets where it would be safe. So I'll give you some of those options here as well. And before I spill the beans on those, make sure to smash the like button if you haven't already. And if you're enjoying this content, make sure you subscribe. So the first thing that you could just do is just invest into the S&P 500 index, right? This is the thing that returns 9.8% per year, and it's done that over the last 90 years. And for those of you who don't know what it is, it's just an index that contains the largest 500 companies in the stock market, more specifically in the United States. Now, what you could do is you could just buy an ETF, such as the SPY, created to track the price of the S&P 500. So if you're thinking, well, I just want to get at least what the stock market has done over the last 90 years, and the S&P 500 being one of the best performers, that might be a good route for you. SPY, if you want to go take a look at it. Another one that I personally like as well is the Russell 2000. And if you want to take a look at this one, it's IWM for the iShares Russell 2000 ETF. Now, another thing that you can do is you could actually have someone else manage your money, and that's where the fees come in. But if you do this properly, you can also make some pretty sick returns. And I don't mean returns that are going to kill you. I mean returns like this that you see on the screen here. If you take a look at the left side, you can see the fund name, and in the middle, you'll see the 7-year return. And on the right-hand side, you'll see the 1-year return. Remember that the mutual funds do have fees, and the average fee for mutual funds is between 0.5 and 1%, and rarely exceed 2.5%, but always double check before you invest in a mutual fund. All right, so I hope you got a ton of value from today's video on how to retire rich. And a quick recap for you is to avoid fees, make sure to contribute to your 401k and IRA, see your options for those plans as well, and make sure that they're set for your preferences if your employer allows you to set your preferences. Because at the end of the day, it's not your company's financial future that we're worried about, it's yours. Again, thank you all so much for watching, and I'll catch you guys in the next episode. Peace out.